Good morning, everyone. This is Bruce at Fleet Capital Management. It is May 7th, Saturday morning. What a week. What a week in the market. It was absolute insanity. I'm going to show you today what happened last week. I'm going to give you, hopefully, a little longer term perspective that might help put the current market condition into perspective for you. Then we're going to talk about stops. I got a very good question from a client, Jim, about different types of trailing stops. He thought there was only one trailing stop. So I'm going to show you that. And then I'm going to show you our current stops. And I think I'm going to start after our disclaimer about a little theory of our economy that I'll share with you. So let's go over, let's see, where is, bear with me, I'll find it. We have to do this first. This video presentation is intended for educational purposes only, and I really do hope that you learn from these. The discussion of any security is not a recommendation to purchase or sell that security. You're watching this via YouTube. I would ask you to hit the subscribe button. The benefit to that is you'll always have all of the content. You can always go back and watch previous videos or this same video multiple times, so you don't have to worry about losing the link. If you're a client, you'll always receive an email when I update new video content. If you are not a client, it's very rare that I let you know that we've updated. So you might want to hit that alert button so that YouTube will alert you each time there's new video content. And I will tell you, I try to do this weekly, and I do it either Friday late afternoon or more probable it's Saturday morning because I'm still accumulating data on Friday, but it's always Friday or Saturday. If you watch this and you have any questions whatsoever about anything that I talk about, please email me, bruce@fleetcapitalmanagement.com. Also, just like Jim asked that we talk about trailing stops, if you have any topic or even a stock or an ETF that you would like me to cover and just do a technical analysis overview of that particular stock, again, shoot me an email and give me that stock or ETF symbol, and I would be more than happy to do that. So let's close out of this preview and let's go over to here. Let's go over to the market. So right now we're looking at the SPY, which is the S&P 500. I drew this vertical white line so that you could see when January 1st of 2022 was, and you can see that since January, this has just been a hellacious market with wild swings up and down, as you can see. And also enormous bars. I just can't impress you enough. These are not normal. Normal are this size bars. And the bar, remember, is, it's called an open, high, low, close bar. So the tick to the left is where the market opened that day. And the tick to the right is where the market closed that day. So you can see it went up just a little bit higher than the close. Let me find another good example. Here's a great example. Here's a market that opened here. I remember this specifically. The market traded way down, and this would actually be a good example when we talk about stops. And then it reversed course and it closed almost near its all-time high. Not its all-time high, its daily high, excuse me. Here's another one. Market opens down, closes high. Here's another one. Market opens down, closes high. But here's a reverse. Market opens up here. It looks like it's going higher, and then it just falls out of bed and closes down. So the two things I want you to take from this chart is the absolute magnitude of the up and down motions. You can't really find a trend. And the magnitude of these daily price swings are just pretty incredible, not something that we're used to seeing. So that's the beginning of this. I want to show you that I've got a couple of lines drawn. Let me see if I can pull up that other line. Oh, no, on this one, there's only one. Okay, so this was the low, the intraday low of the market. And we'll use a previous intraday low as when the market comes back down, will it test that low? And you can see the last week or so, market came way down, actually breached that low, but it closed much higher. So, and then it came down and it actually touched the low. Here on Friday, it breached the low, but it closed much higher than the low. So you can see or what I hope you can see from this is it may be telling us that the market has found support at this level. A prior low is a pretty powerful support level when it comes to stops. And we're going to get back to that. So you're seeing this immense amount of volatility. Everybody felt really great here. We thought we had finally hit a bottom, but then it just turned over on us. So I want to try to help you with something that I look at, but that you may not have access to. We're looking at a daily chart. What happens if we take exactly the same data, nothing changes, but each bar becomes 1 week? So now we have an interesting picture that is a different picture. This was 2020. This was right when COVID came out. We had this massive downturn, but then look what happened. This is called a V-shaped bottom, came right back up. And each one of these bars is one entire trading week. And look at the run we had. And then January 1st, everything kind of stopped. And on this chart, same data, but now we're looking weekly, it almost looks like all we're doing is consolidating following a strong uptrend. Now, remember what I taught you in an earlier video. The market can only do 3 things. The market can go up, the market can go down, and here's a little example. The market can go sideways. So the market went up over here, and then it kind of went sideways. It consolidated, it started to go up, it consolidated, started to go up. These are very short consolidations. It went up and then it dropped, came back up. And when you see the blue on this particular one, it's kind of a consolidation. That's what it means. So you could even have little consolidations inside an up or a down trend. But again, let's go back big picture. We had a very long uptrend. And on this weekly chart, this does not look like, to me, anything but a consolidation. If I drew a line here, and you already have this pink line down here, it looks like the market's just going sideways, doesn't it? So sometimes it's really important. Now, let me go back to the daily chart. Same information. You can't see anything but paint on this chart. You know, there's just nothing to see. So we always go out, take a look at the weekly, and again, this looks like a consolidation. Now, what happens after a consolidation? The majority of time, not always, following a consolidation, following an uptrend, it normally starts to head back up and breaks new high. That's the majority of time, unless we're going into a much lower market. Then we're consolidating. The market's trying to get a feel for what it wants to do next, and it could drop lower. And my next target would be this 200-week moving average. I don't predict, and I don't know what the market's going to do next week or next month. But here, I'm just going to give you a theory. This downturn has been caused in part by hyperinflation. Well, then the next logical question should be, what caused that hyperinflation? And I will tell you that the majority of the cause was COVID. So there was a long period of time where the economy was pretty much shut down, and we were doing very little shopping. We weren't going to restaurants. We weren't spending a lot of money. And so the economy naturally contracted. And if you're a business owner, you are not going to order a lot of inventory because there's not a lot of customers coming in. And so that was sort of a natural contraction because of COVID. Then what happened is we dropped a lot of the COVID mandates. The economy, state by state, started to open back up. And since people hadn't spent money in a long time, they had this huge amount of cash availability, and they spent money with a vengeance. And because companies didn't have enormous inventories, they didn't know how long we were going to be shut down. They had to rush out into the world markets and buy inventories. So they're buying inventories at, remember, supply and demand. Everything is supply and demand. The demand is now enormous because they have to catch up and get their inventories. But at the same time, shipping companies had left, and it's mostly coming from China, but shipping companies had let go of a lot of employees because people weren't ordering and they weren't shipping the goods. And then once the ships got into our ports, mostly in LA, we didn't have enough workers to unload the ships. Again, now we have tremendous supply, we have very little demand. we have very little supply and excessive demand. And so it keeps pushing inflation up. Then we have the Russian war or attack, if you will, in Ukraine. And we have all kinds of issues with the crude oil flow and some risks and some, Putin is threatening he's going to turn gas off. And so that's pushing oil prices up and gas prices up. So this is all coming, COVID, war in Ukraine. And I really believe that that is the cause of the inflation we're seeing. So let's say the war is over soon, which nobody knows, but I suspect and hope it will be. Let's say oil prices start to come down, which I absolutely believe is going to happen. And let's say the supply chain opens up, because now we're kind of out of COVID, if you will. Do you think we may have seen the high of inflation? Personally, and this is not a prediction, but it's just from living through this, yeah, I do. I think we could see the war end. I think we could see oil prices come down. And I think we may have crested the high of inflation. If those things or any combination of those things actually happens, and again, I don't know when, it could be this week, it could be next month, but I do believe then this consolidation that we were just seeing, let me pull it back over, could break back to the upside. That's what I anticipate. That is what I anticipate. And this drawdown, anytime you go from a recent high to lows, this drawdown is certainly doesn't look as significant as this drawdown, and it's not. It's not anywhere near. It's about half. So maybe that helps put, and I'm trying to keep you in the market, because when this thing turns, it will turn with an explosion. When this market turned, and everybody thought this was a new bear market. Everybody thought this was, we're just going into the tank because of COVID. It changed with a vengeance very rapidly. And I'm trying to keep you in, because that's what my theory is that things are going to get better. They're nowhere near as bad as the news makes them out to, and we're going to go higher. So I have been trying to keep you in the market. With that said, and when we get to stop management, you have to draw a line in the sand. Before we leave this, I'm going to go out to a monthly chart. Same data, nothing changes. Here's the beginning of January for this year. Look at this. This is now 2009. This is following the 2008-2009 recession. Of course, we have ups and downs, but look bottom left, top right. We get up here. We've had this incredible run, and we start going what looks sideways. Sideways is normal. Sideways is healthy. Here's a consolidating market. Here's a consolidating market. Yeah, it went down a little bit. Markets need to rest. And so this actually doesn't look very bad, does it? I don't think it does. And even weekly, it doesn't look that bad. It just looks like a normal consolidation, but I can't guarantee that. So what we do is now we're going to work our way back to daily. Okay, now we're looking at the daily. So now let's start to talk about stops and different types of stops. I'm going to take you to another chart. If you remember, these dots are called ATR, or average true range. And I have two different system settings. That's why there's two different charts. And right now, I'm not going to explain to you exactly how this works. But let me talk to you about trailing stops for a second. And let me make sure, yeah, we are on daily. So this is a daily chart. Okay. So you can put in a stop that trails, and I'm going to bear with me. I'm going to look for a really good example of this. Okay, let me blow this up. Let's blow this up, and let's take this stock. So the market comes down and the market opens here, and let's say we put in a trail, an intraday, it's happening during the day, 2% trailing stop. And that means every time this stock or the market goes higher, our stop will trail higher. But what happens more than not is the market goes down, and let's just pretend this is 2%. We get stopped out. We're not in the security anymore. And then in the same day, it runs back up, and we miss some of this. This is kind of a good example. This happens all the time in intraday trailing stops. It just does. And I used to use intraday trailing stops quite a bit. And then after getting whacked out of a number of securities and missing upside, I went back and I did a lot of research comparing intraday to end of day stops. So let's say here, I put in a 2% end of day trail. Nothing happens during when the market's opened. The market closed here. So actually my stop went up. Now I'm starting here and will allow it to go down 2%. That's an end of day trail. You don't worry, you don't allow your stops to trigger intraday. Well, I did an enormous amount of study on that, and I'm happy to show, I show everything. I'm happy to show the studies. I have to go back and find them. But it showed with crystal clear clarity that end of day stops worked better than intraday stops in generating greater profits. So I switched to end of day stops, okay? Now, that's what we use is end of day stops. Sometimes you get caught in a big downdraft and using like ATR stops or something like that isn't working. And there are reasons we got caught up in this that I've already talked about. And it's not for our defined outcome securities. I'm going to talk about that in a few minutes. This is just for people who have QQQ, SPY, a couple of other stocks. We don't have that many. But once you kind of miss an opportunity, then what you do is you find a technical stock and a stop or level of support and resistance. And that's why I drew a line here. This was the lowest spot this year. And you can see that I have that here. And what I did was I have put in, as of the other day, 1% below there for this stock, which is the SPY. That would be a price at 404.50. Now that can trigger intraday because once you go to a fixed stop, there's no way to do it end of day. Here was my end of day. And then I put in a stop at 405.50, 404.50. It hasn't hit 404.50 yet. It's come really close. This might not be in exactly this right spot. It's come close, but it hasn't hit it yet. Right now we're at 411.34. Down here, I think it went as low as about 405.86. So I thought we were going to get stopped out, but we didn't. So what this is called is not really a trailing stop. This is a line in the sand stop. If we go now below this line, I'm not going to let it go any further. And what I do is every single day, let's say Monday, and you can see we haven't closed below this. Let's say Monday we go up, I might raise this up just a little bit. I'm going to make up a number. Maybe I go to 405.50, 406.50, 407.50, because our goal is to stay in the market. But we have to have a line in the sand. And so I will show you, and again, not everyone owns the same securities, but if you own SPY today, this minute, there's a stop in for 404.50. I don't know if we're going to get stopped out, and I hope we don't, but we might. For the Qs, there was that line in the sand, came down, but it closed above it. I have a stop in at 305. It's at 309.25. And these stops, when I get to line in the sand, which is kind of call uncle, are normally 1%. They're really close. Some of you own VIG. It's a dividend investment. I have a line in the sand. It's at 152.98, really close. I'm at 150.25. Some of you own MGC. It's mega cap stocks, closed at 143. I'm at 140.50. And you can see, look at the power of this line. Look how it came down. Look how, but it never, look how it closed just above the power of the line. That's normally what support and resistance does. So I know I'm belaboring this, but I really want you to understand that there are multiple types of stops. Once we get out of this mess, and we will, but once we get out of this mess, we are going to immediately go back to end of day ATR stops. So we may put our stop just below here. And when the ATR rises, our stop will rise, and then the stop will stay the same. And then when it rises, our stop will rise. This is called an ATR, end of day trailing stop. And then if we had our stop here, we would have gotten stopped out, clearly. But you can see the market kind of bounced around. And then again, I won't explain the technicals on this, but then we probably would have gotten back in right about here, right there. So we will go back to ATR stops We are where we are now with some of these securities. We've got a year low. I've got a fixed stop in. I hope upon hope that we don't get stopped out. My guess is we will. They're pretty tight. And my other guess is that this market's going to go back up. But since I don't know when, we're going to stop out and just take that loss if it happens. So I hope that helps. That there are intraday trailing stops, there are end of day trailing stops, there are trailing stops based on technical analysis like ATR, and there are stops based on support and resistance lines, or uncle lines, sometimes we call them, that we're just not going to let it go below that. So I really do hope that helps. Let me see. I have a couple more things for you. This is, okay. I'm going to show this each week because for some reason they're confusing, but even if they're not confusing, I want to show you, there's really no way for you to see this without seeing it on my computer. This happens to be our single largest holding across my entire clientele. Some of you own 10% of this, some of you own 50% of this. I mean, everybody owns different amounts. But when I look at my entire business, this is the largest holding. So this is Buffer APR, April, S&P 500. And you can see this is April 1st. This is when it started. The little line, I guess I would call that a teal line, is the actual SPY, the S&P 500. And the darker line with the little bullets or circles is our actual investment. And remember, all year it's kind of been down. And since April, it's been down. But we can see the numbers here. The SPY since April 1st is down 8.92%. And this is as of Friday night. And our fund is down 6.6%. So if you look over here, as long as we're in the gray area, here's the fund, here's the SPY, as long as, not the SPY, as long as our investment is in the gray area, which is a negative 9%, if this were maturity day, we get our money back. Almost all of the money back. They have a little fee in there, built in, a little management fee. But for all intents and purposes, we get our money back. And we don't care where the SPY is. The SPY could be down 15%, but if we're still in this gray area, and just so you know, the investment has something in investments called drag. I can't really take the time to explain that to you, but that's why this is doing better than the S&P. But let's say the S&P was down 15% and our investment was down 9%. We're still beating the S&P, but on maturity day, it snaps back. This one does, back to the zero line, and we get our money back. So as of Friday, that investment is down 6.6%, but I say, who cares? It's in the buffer zone. That's not really our loss. Now, granted, if our investment goes down 10% and we have a 9% buffer on the last day, let's just say that is the last day, we're down 1%. You know, again, that's why I don't get upset about these things. I know they show that you're at a loss, but you don't own that loss as long as we're in that gray area. Okay. One more. This is my second largest holding in my entire business. This is on the Qs. Same type of thing. Big difference. The Qs have a buffer of 15%. It's just, these are sophisticated securities, and the math works out differently for higher volatility securities, and the Qs is higher volatility. So what we know right now is since April 1st, the Qs, the NASDAQ's down 14.7%, which is just a big drawdown. We're down 8%. So we're about, I don't know what that is, 40% less. I mean, we're beating the market, which is fine, but who cares? We're in the gray area. We're going to get that money back if this was maturity day. If this, which is the Qs, that light teal, goes down 30% and we're down 15% on maturity, we get our money back. So that's why I just don't sweat the vast majority. And I own hundreds of these things, all kinds, but these just happen to be the two biggest concentration symbols. That's why I don't sweat it. I know it's hard for you to look at a statement and see negatives, but I know these negatives don't belong to you. I guess that's the difference. Okay, so I have shown you the market. I have zoomed out to weekly. Doesn't look so bad. Looks like a consolidation. Monthly looks even better and looks like a consolidation. Let's go back to daily. I've shown you that. I've shown you that I did draw a line in the sand. which is prudent to do. And we do have fixed stops in. Those are called fixed now, even though I might change them if the market starts going back up. And if it goes back up, and goes back up above the ATR, then we'll switch to the ATR stock. We will switch back to using this, which is a better stop. But our goal now is, let's see what the market does. Let's see if this is truly a consolidation, but we're not going to wait anymore because I know that investors can only take so much. I will tell you this, now I trade alongside of you. I do pretty much every trade you do, and I've put these stops in on my account. But if I didn't manage anyone else's money, and I was only managing my money, I would not have these stops in, because I have been through this too many times over 36 years. And I know this market's going to respond, and it's going to respond with a vengeance. But I also know that as we get older, and a lot of you watching this are in your 70s, 80s, 90s, that fear gauge starts to make you lose sleep. And so I have these fixed stops in, and they're in on my account. I do everything I do for you. If we get stopped out, we'll just watch for the right opportunity to get back in. But know that there will big up days that we won't go back in, because you can't just jump in on one day. You actually have to have an indicator that shows you a time to go back in. The very last thing that I want to show you is VectorVest, which I also use. And again, I won't explain all of the underlyings, but BSR is a buy to sell ratio. In their history of 30 plus years, and this is on a scale of 0 to 2, a strong market is 1+. Anything over 1 is just a strong market for this particular indicator. In their history, when this gets down to about 0.2, it suggests we are at or close to, very close to, a bottom. That's what their research shows. The MTI is a piece of analysis that looks at multiple things. And again, its scale is 0 to +2. And 1+ is always a very strong market. But the reason I show you this is their research over all their time shows that when MTI gets down to 0.6 or less, and we've kind of been hanging there for quite some time, as you can see, when it gets to 0.6 or less, we are at or near a market bottom. That's just what their research shows. So we use a lot of different decision points to help. I do believe we are at or near a bottom, but I cannot bet on it. I can't, with your money, I can't tell you that with absolute certainty. I can only tell you, remember, we have a phrase, look left to learn, because we don't know. This is next week. It hasn't happened yet. So based on look left to learn, I feel like we might be at a bottom, but I can't guarantee it. So I have put in hard stops, and we'll just manage around that. So that's it. I don't want to take too much more of your time. Again, the purpose of these videos is to tell you what I'm seeing, to share with you what I'm seeing using technical analysis, to also show you how decisions are made, to give you some kind of a future, not guess, but based on a lot of knowledge and analysis and history, I should say, and probabilities, what we might expect going forward, but also education to show you that there are multiple types of stops. I will tell you, the last thing I'll tell you is, in my industry, and I talk to people all over the world almost daily, stop management is the singular most talked about topic in the investment world every day. Not which stock to buy, not how's the market doing, not it is stop management, because there are so many opinions on stop management. It is so complex, and you just have to choose one and then stick to it. And that's what we're going to do. That's what we're going to go back to the ATR end of day. That seems to be the best of the best. But I hope that you've had some education in this. I covered a lot of ground. So you can rewatch the video, but you can always send me an email and ask any questions, or ask me to cover any particular topics in future emails. So thanks for your time this morning. Very much appreciate it. We're going to wrap up for now, and I will talk to you soon. Bye-bye.